Welcome to the Deep Dive. Today, we're cutting through the noise of the latest financial filings and investor calls.
That's right.
We want to really understand the engine driving Adani Green Energy Ltd, AGL. They're one of the most aggressively expanding renewable energy companies out there.
Definitely. We're looking at their results for the quarter and the half year ending September 30, 2025. So that's H1 FY26.
Okay.
And what we're seeing, I think, is a company that's not just growing, it's fundamentally challenging the global pace of clean energy development.
Right. So the mission today is really to unpack this central tension. How do they manage this just immense scale and the huge capital needs?
While also navigating, the immediate hurdles, like grid availability, getting all that new power actually connected.
Exactly. That's the core story, isn't it? It's not just the big headlines. We're aiming for a detailed look at the trade-offs. Speed versus stability. AGL is cementing its place as India's top pure-play renewable provider. And their strategy seems to be all about these massive, almost dizzying greenfield capacity additions.
Yeah, we're looking for those economic secrets kind of buried in the footnotes, you could say.
Yeah.
We're moving past just the planning stage here. This is all about execution now.
Right.
The numbers really show an organization just running at maximum velocity. They're forcing the pace for the whole market, really.
Okay, let's start with that scale then, the operational picture. The numbers are almost hard to wrap your head around sometimes.
They really are.
As of September 30, 2025, their operational RE capacity just exploded. It was up, what, 49% year over year?
49%, yeah. Reaching 16.7 GW.
Wow. That's huge.
And importantly, that 49% isn't just small projects adding up. Look at the first half of the fiscal year, H1.
Right.
They added 2.4 gigawatts of greenfield capacity. Just in 6 months.
2.4 GW.
Yeah, and just for context for you, that single half year, that's 74% of the capacity they added in the entire previous year, FY25.
74% in half the time. So they're really accelerating.
Breakneck speed, exactly.
And acceleration means actual power flowing, right? Energy sales were up 39% year over year.
Hit 19,569 million units.
And the company gave a great analogy, I thought. They said that H1 production alone is enough clean power to supply, like, a whole country.
Yeah.
Like Croatia.
Yeah.
For a year.
It really does put the magnitude in perspective for you, doesn't it?
It does.
And, despite adding all this massive new capacity, which is complex to integrate,
Sure.
their operational metrics, the CUF, the capacity utilization factor, they held up really well in H1.
Oh.
Solar CUF was 24.8%, plant availability 99%. Wind did great at 37.8% CUF, and hybrid assets combining solar and wind were actually the highest performers at 39.1% CUF.
So the core assets are running efficiently then?
Seems so, very efficiently.
Okay, this brings us straight to the project that kind of defines this scale for them, doesn't it? Kavda.
Ah, Kavda, yes.
It feels like their whole 50 GW by 2030 plan is distilled into this one massive project.
Kavda in Gujarat, it's absolutely foundational. It's planned as a 30 GW powerhouse.
30 gigawatts.
30. And already 7.1 GW is operational. That's solar, wind, and hybrid together.
Wow.
Management correctly calls it the world's largest RE plant. It covers 538 square kilometers.
5 times the size of Paris. That just... The logistics must be insane.
You'd think so.
But the focus should be on the tech, right? Because that's where the economics come in. What are they actually using to make sure this behemoth stays profitable?
Yeah, good point. They're really trying to maximize every inch of that land with advanced tech. They've got bifacial solar modules.
Capturing light from both sides.
Exactly. And trackers, so the panels follow the sun. Crucially, they've installed India's largest wind turbine there, 5.2 megawatts.
Okay.
But the real insight, I think, for long-term operating efficiency is the massive use of waterless robotic cleaning.
Waterless robotic cleaning. Okay. Why is that more than just a cool gadget? Why does that really matter to the bottom line?
Well, it's a critical economic difference maker in dry places like Gujarat. Think about it. If you have to truck in millions of liters of water every day just to wash panels, which you have to do to keep them generating efficiently,
Cost that up fast.
your operating costs just skyrocket. So by using robots and getting rid of the water need, they're slashing operating expenses, which improves the long-term ROI. And it avoids issues with local water scarcity, too. So this isn't just, green tech for show. It's an economic strategy.
To make that 50 GW target viable, cost-wise, over decades.
Precisely. That's the idea.
Okay, let's switch gears. Let's talk capital. When you're executing at the pace of Kavda, the money side has to match up. How do they actually perform financially in H1 FY26?
Well, the financials definitely reflect that build-out we talked about.
Yeah.
Revenue from power supply was up 26% year over year, came in at 6,088 crores.
Okay.
And EBITDA from power supply, it followed suit, up 25% to 5,651 crores, which really shows the consistency of the underlying business model.
That EBITDA growth is pretty staggering, isn't it? They pointed out that their H1 FY26 EBITDA already beats the total annual EBITDA for the full fiscal year 2023.
Yeah, that's pure acceleration right there.
And the margin.
Yeah.
Still incredibly high.
Oh, yeah. The EBITDA margin clocked in at an industry-leading 91.8%. Highly consistent, too.
Wow.
That's largely thanks to those long-term fixed-rate power purchase agreements, the PPAs. They really secure the revenue stream.
Right.
And that high margin efficiency, it drove their cash profit up 17% year over year to 3,094 crores.
Okay, so given the ambition, let's look ahead. What's the kind of capital expenditure needed to keep this machine running at this speed?
Yeah, the cash is definitely flowing out almost as fast as it's coming in. Management guided for capex of roughly 30,000 crore for the full FY26.
30,000 crore.
Which is directly tied to their goal of adding 5 gigajoules of capacity this year.
Makes sense.
And looking further out, they're forecasting an annual capex of somewhere between 30,000 and 35,000 crore for the next 2 fiscal years as well.
So huge spending to keep that development pipeline full.
Massive amounts, yeah.
Which immediately brings up the L word. Leverage. Debt.
Always does.
When you're building this fast, debt's unavoidable. Their net debt to run rate EBITDA, it looks high, around 4.4 times for operational assets, or 5.1 times if you include debt for projects still being built.
Yeah, it is high.
So why is the market apparently comfortable with them running in that 4x to 5x range for the next few years? What's the thinking there?
That's really the critical analytical question, isn't it? The leverage is high, but the market seems to accept it because it's backed by those highly predictable long-term PPA cash flows.
The PPAs again. Seen as non-cyclical.
Exactly. The debt is mostly project finance debt secured against assets that have guaranteed buyers for their power.
Okay.
Management expects to stay in that range until about 2029. By then, the idea is that these huge assets they're building now will be fully operational.
Generating maximum cash flow.
Right. And they expect a sharp drop in that debt ratio as the EBITDA catches up to the debt load.
And managing that debt was helped significantly recently by a big equity move, right? The warrant conversion.
Precisely. That was definitely a strategic move, balancing the books while still funding growth.
How much did that bring in?
They completed the full conversion of 63.14 million warrants, raised a total of 9,350 crores.
Significant sum.
Very. And those funds weren't just, sitting around. They were strategically used for debt repayment, investing in perpetual debt of subsidiaries, and general corporate stuff.
So a deliberate equity injection to buffer the high operational debt needed for that 50 gigavalue timeline.
That's how it looks, yeah. A way to de-risk the balance sheet somewhat.
Okay, let's pivot now to some of the operational fine print. Specifically, how they make money from assets that are built, but maybe not fully tied into a long-term PPA yet. They talk about selling infirm power.
Yeah, this is actually a pretty shrewd tactic. Infirm power is basically merchant power. The strategy is get the assets commissioned early, get them generating power.
Even before the main contract kicks in.
Exactly. And then sell that initial power at market rates, merchant rates, while they wait for the long-term PPA to become officially operational.
So it's like an extra revenue stream at the beginning, an add-on.
Sort of an add-on, yeah. Improves the overall project economics right from the start, before the big contracted revenue starts flowing.
Interesting. So what were the prices they actually got for that merchant power in H1 FY26? Did they reflect the market? Okay.
They did. And here's where you see a really interesting financial signal. Solar averaged about 2.1 per unit. Plus, you get the extra income from renewable energy certificates, the RECs.
Right, the green attributes.
But look at wind. Wind power sold on the merchant market realized significantly higher prices. Averaged 5.13 per unit.
Wow, wind getting more than double the rate of solar. That's fascinating. Is that just location, or does it hint at something about market demand?
I think it points directly to the value of wind power often acting as peaking power. Merchant prices can spike during peak demand hours, right? Evenings, early mornings. If their wind capacity is generating and selling when market prices are highest, the realization rate jumps up.
And was this a significant amount of power?
It wasn't tiny. Wind made up about 34% of the capacity they were selling as merchant power in that period. So yeah, quite significant.
Okay, but when you execute projects this fast, 2.4 GW in 6 months, you inevitably run ahead of some of the supporting infrastructure.
True.
The sources noted a specific, immediate hurdle with grid availability, especially for solar.
That's the main technical trade-off, yes. Grid availability for solar actually dipped sequentially, dropped from 97% down to 89%.
89%.
And the management team explained this. It's basically because their development speed is just outrunning the transmission build-out.
The wires aren't ready yet.
Right. The grid connection comes in these big chunks like 2.5 GW, 3 GW, or even 5 GW tranches. And sometimes the power plant is ready before the grid connection for that specific block is fully energized.
Wait, hold on. If solar availability dropped from 97% to 89%, that sounds like almost a 10% operational hit, doesn't it?
Yeah.
How do we square that with management saying the overall financial impact is currently less than 5% across the whole fleet?
Yeah, that's the key distinction to make, that 89% figure. It's primarily hitting the newly commissioned assets.
Not the whole portfolio average.
Exactly. For the overall financial picture, the impact gets diluted because the vast majority of their 16.7 GW operational capacity is already securely connected.
Okay.
It's kind of a necessary operational sacrifice, you could argue. They'd rather commission early and face a temporary grid constraint than delay the whole asset and lose months of potential revenue entirely.
Got it. Okay, shifting to regulatory challenges then. AGEL is constantly dealing with these long-running PPA disputes with state distribution companies, the DISCOMs, right? Their main customers.
Absolutely. It's part of the landscape in India. They're actively managing complex tariff disputes with various regulatory bodies, UPPCL, Tangico, names like that.
And their strategy seems quite aggressive there, too.
It is. They continue to recognize revenue based on favorable lower court or tribunal rulings.
Even if the state utility has appealed it higher up, like to the Supreme Court.
Yes, even then. For example, there was one subsidiary, AGEL. The cumulative revenue they recognized from one specific tariff dispute hit 115 crores by September 30, 2025.
So they're booking the revenue based on the current favorable ruling, even with the appeal pending.
It shows they're actively fighting to lock in revenue at the highest rate possible, navigating this really complicated web of state-level power agreements.
Okay. Finally, we do need to touch on the governance note. The auditors flagged something in the filings about those U.S. regulatory issues from last year.
Yes, we have to report this impartially. The auditors specifically drew attention to notes 7 and 8 in the financial statements.
And what did those relate to?
They concerned an indictment by the U.S. Department of Justice and also a civil complaint from the U.S. SEC against certain directors. This was from the previous fiscal year. Now, company management publicly stated they hired external law firms, conducted an independent review, and that review concluded there were no non-compliances or irregularities. So management's conclusion was no material consequence to AGEL as a company.
But the auditors still felt it needed to be highlighted.
They still felt compelled to draw attention to it in their report.
Yes.
As an ongoing matter.
So let's zoom out. What does this all mean? Our deep dive seems to show a company defined by these twin strategies.
Right.
First, incredible speed of execution.
Definitely.
You see in the 2.4 GW in 6 months, the sheer scale of Kavda. And second, this sophisticated financial maneuvering, leveraging huge capital infusions like the warrant conversion to handle high debt.
The focus is laser sharp on momentum, hitting that 50 GW target by 2030. But the market environment they're building into is changing. Quite dramatically, actually.
How so?
Well, tendering is moving away from just pure solar or pure wind capacity. Governments, utilities, they increasingly want peak power solutions or round-the-clock reliable power.
Which inherently demands massive investment in energy storage.
Batteries.
Precisely. Battery energy storage systems, or BERS. Storage is becoming, almost an existential need for truly reliable, continuous clean power.
And AGEL is aware of this shift.
Oh, yes.
Yeah.
The company has confirmed it's actively developing BERS capacity. They used the phrase unprecedented scale and said they intend to unveil a full strategy soon.
Okay, but here's the crucial part, right? They haven't yet publicly included that potential storage capacity in their main 50 GW goal for 2030.
Not explicitly, no. That goal still seems primarily focused on generation capacity, solar, wind, hybrid.
So here's where it gets really interesting for you, the listener, to think about. Given this clear market push towards storage, given AGEL's massive capital war chest from things like the warrant conversion and their stated commitment to developing BERS, how quickly will they actually unveil these BES capacity plans?
And will this new storage segment completely redefine their growth curve? Could it push them far beyond that initial 50 gigaliters plug target? That strategic announcement on BSS, whenever it comes.
It'll tell us everything about their next phase of growth. We definitely encourage you to watch that transition closely.
Absolutely. Okay, that's all the time we have for this deep dive. Thanks for tuning in.